So what the heck is a date the rate loan program? Well, what that means is, and you've probably heard it, marry the home, date the rate. When we get into a high interest rate environment, when you buy a house, you're committed to the house. Nobody typically intends to buy a home and only live into it for a year or two. You're going to live in it over the next 5, 6, 7 years. When we say date the rate, that really means date the mortgage. We know that rates are high, but we also know that they're not going to stay there forever. As soon as we start to see the inflation rate come down, we will also see interest rates come down. It's just they will likely have to go up a little bit more before that happens. And so I am expecting by the end of Q1 of 2023 that we will start to see them come down. But should that stop you from buying a home? Absolutely not. This is the market that buyers have been waiting for, because the last couple of years, in order to compete, you had to waive all contingencies, waive the appraisal, and in the DFW area, you were bringing like $100,000 over list price just to get into the home. And so you can avoid all that. You can negotiate with the seller. And so you have to be strategic then with the mortgage and with the rate. So what I want to do is I want to explain to you what this date the rate loan program looks like. It is a little bit confusing, so that's why I've recorded this video. It is called a 2-1 buy down. I just want you to be familiar with the terms, because now that you're paying attention to this kind of stuff, your ears will be more perked up when you see things on social media or on the news. The technical term is called a 2-1 buy down. I call it the date the rate program. And what it does is it allows you to start with a 2% lower interest rate than the current actual rates for the first 2 years. So what that means is you sign up for a 30-year mortgage. The first year, it's going to be 2% lower. The second full year, it's going to be 1% lower than the actual rate. And then on the third year and beyond, it adjusts to that whatever the current actual rates are. So let's just say hypothetically, to make it easy, the current interest rate today that you could lock in for a 30-year fixed rate is 7%. In this temporary loan, or this date the rate loan, you would be starting out with an interest rate of 5% for your first 12 months. Then when that second year hits, the rate would go to 6%. And then on year 3, it would go to the 7%. Now, why in the world would you do this? I'm going to show you the math in a second, but it's because we are predicting the rates to drop. And so we are going to rewrite this mortgage for you with zero out of pocket. We will rewrite it for you before you even get to that third year. With how fast rates have moved this year, there is no way we are going to stay here. So we are predicting likely 2 to 3 years max before we start rewriting loans. I'm predicting it'll be by the end of Q1 of next year that we might see rates back in the 5%. And that is why this is called dating the rate. But it's foreign, because for the last decade, all we've really heard is 30-year fixed rates. In fact, when we heard of any kind of exotic loans like ARMs, or we think they're the devil, because we think that that's what caused the housing crash. And it's actually not what caused it. What caused it was the fact that people were on these adjustable mortgages and lenders didn't have to verify income. So you could say you were a janitor making $500,000 a year and you would get a mortgage, and when those rates started adjusting, guess what? That janitor couldn't afford the mortgage because he wasn't actually making $500,000 a year. And that's no disregard to the janitor, everybody was doing it. So it wasn't the actual loan structure, it was the loose lending laws that were there at the time. So let me show you the math on how this works, because this is what's truly eye-opening. This is a calculator that I'm more than happy to share with you. And so let's just say you're buying a home for $550,000. You're putting 10% down, and the going interest rate, let's just keep it at 7%, just to keep it easy. 7%. What that means is that on year 1, you'd have a 5% rate. Your principal and interest payment would be $2,657. Versus the 7% rate would be $3,293, and it's going to save you $635 a month in your first 12 months by that lower rate. Then year 2 comes along, and your rate goes to that 6%, because now we're just one below. Your mortgage payment goes to $2,967, still saving $325 a month until that year 3 kicks in. And so for the year, you saved $7,600 in interest on year 1, $3,900 on year 2, for a total savings in your first 2 years of $11,537. This is what your real estate agent, depending on the type of home, the seller, where it's located, this isn't a guaranteed strategy that you can do on every single home. That's why you have to listen to your agent. But you could go and make an offer on the home and say, hey seller, I'm going to offer you $662, but I want a $12,000 seller credit so you can utilize this date the rate loan program. And then you can save this on your monthly payment. We're still going to make sure you qualify at the 7%. A lender's always going to qualify you based on worst case scenario. You still need to know that this is, let's just say something catastrophic happens and the rates stay at 7% and they never, ever, ever come down. We still have to make sure that you can afford this. It's highly unlikely, but I am let's prepare for worst case scenario. This is a way for you to save a boatload of money. So this calculator automatically calculates what you can negotiate from the seller. And then, you could go at them at, okay, it's listed at $550. I'm going to offer $550 and this, which means the seller is going to net, this minus this. That's really what you're saying. And if you're a seller, you could sell your house and you could say, hey, you could buy my house with a 5% interest rate. Let's learn now. And a buyer who cares so much about monthly payment, because that's the issue that America is into right now, is affordability. People care a lot less about the price of the home than they do the payment. Why? Because nobody stays in their home for 30 years anymore to pay it off. You're just paying the monthly payment for that home. And so you could advertise, hey, come buy my house. I will sell it to you with a 5% rate. And there'd be some disclosures because you can't actually quote weight. But this is a lot more appealing to buyers than it is lowering a sales price. Now let me show you this. This is just a side-by-side so that you can see. Give me 1 second. Because some people have asked me, well, here's the date the rate loan example. Here's a 7-year fixed mortgage, which means the interest rate is fixed for the first 7 years, and it would adjust after 7 years. So the people who worry about the first 2 years and prefer the 7, that's an option as well. And then here's a 30-year fixed. Let's just stack them up side by side. Purchase price, let's assume $650. Loan amount, 20% down, $520. The date the rate program would give you a first interest rate for the first year of 4.875. Then it would go to 5.875 year 2, and then it would go to 6.875 for the rest of the 30 years. The 7-year fixed is fixed at a 6.75. For 7 years, it's fixed. And then the 30-year is a 7.25 for the full 30 years. So let's compare. Here's the monthly mortgage payment. You've got $2,751 versus $3,372 even for the 7-year fixed option. And then look at this, $3,547. That's almost $800 a month difference. Do you know what that means from a sales price standpoint? In order to get a $2,751 mortgage payment, that would drop your sales price $130,000. So if you're a seller, you would have to drop your sales price $130,000 to meet this mortgage payment requirement for the buyer. Or if you're a buyer, you would have to be looking at a price point of $520,000 versus the $650 to afford the same home. That is how powerful this date the rate loan program is. And then look, the funds to close are the same. And so if we were to measure these side by side over the next 24 months, how much money would you save? Well, look at this. This is our interest savings over 24 months. This date the rate loan program, you would save yourself $20,000 by picking this option versus a 7-year fixed or the 30-year fixed. If you pick the 7-year fixed, you would still save yourself about $5,300 versus the 30-year fixed. It's just traditionally what? Traditionally, our parents taught us, get a 30-year fixed mortgage. Why? Because they were in their homes for 30 years. They paid their houses off. They stayed there for 30 years, just like they stayed at their job for 30 years. It's just not the modern way that we live anymore. And so it is scary. It's scary to learn these new things because I do think, hey, the housing bubble and the housing crash, it burned a lot of people. It burned some of your parents, and it makes us scared, right? And to get advice from a mortgage professional, you kind of take it with a grain of salt because you're like, Is this just what you want me to do? Do you make any more money on these loan products? We don't. This is just a smart financial way to buy a home in an environment where rates are high. And I don't think rates are going to stay high forever. In fact, people ask me that all the time. I did a presentation on this. When will rates come down? Rates are going to come down when we see this inflation line come down. And it has increased since January of 2021. And the reality is here's where our CPI index is. And August rates dropped up because the August numbers came out here, which was 0.6, which was higher than this 0.2. And so the CPI number went up because we eliminated this August, since it's a rolling 12 months, and we included this. But in the next couple of months, these lower months will be out. We'll start to see inflation come down. Unfortunately, here in our government, in this period here, you see this bracket, from about the end of 2020 until January of 2022, both presidents, Trump and Biden, they kept the rate locked in and they didn't allow mortgage rates to follow inflation. And that's where we messed up. And you know what? We were in the middle of COVID. It's very difficult for any president to get that job, right? You know, you're damned if you do, you're damned if you don't. But we kept our rates frozen rather than allowing them to follow what inflation did. And so here inflation went up because supply chain issues and all the crap that we were having. But you see that the 30-year fixed rates were held because we kept them held. And that's why we saw them shoot up at the start of January, is because we unfroze it. And what did they do? Boom. They went right on track with where inflation was. This will come down. The feds are getting control of it. It's just a matter of when. And so do I think it's going to be 2 years? Absolutely. Do I think this Date the Rate program is a good option? I absolutely do. I just also know that it is confusing. So I hope that you found this video helpful. If you have any additional questions, let us know. Just know that this is ultimately, this strategy is going to be best suited to ask your real estate agent, because every seller, every home is different. If you have a house that's in super high demand, it's priced right, it's going to depend on what that seller will do, because this Date the Rate only makes sense if the seller pays this $11,000. Otherwise, if you're paying it, there's no real advantage, because you have to pay this at closing, and then that's what you save over your first 2 years. You're just paying to have a lower payment. It's not that it's not smart, but you're not truly saving because you're still bringing that to closing. The key is having the seller pay for it. So thank you for watching. Thank you for tuning in. Feel free to share this video with whoever is in the market right now to buy a home. We are licensed in Texas and Oklahoma and Florida, Colorado, Montana. Hopefully more to come. But if I can help, let me know. You can reach out to me. All of my contact information is in the link below, or you can go to www.allnerdinfo.com. Thank you.